Hey everyone, Barry Brooksby here, and welcome to today's training session. I'm glad that you made it because today I get to pass along a skill set to you that completely changed my life years ago. And that skill set is how the top 1% of business owners save and protect their extra cash flow and generate wealth. As a business owner, if you've ever wondered what to do with your extra cash flow every month, today you'll have a clear picture of exactly what you can do to save and protect that money and generate more wealth. And not only that, but why. I teach business owners how to do this, and you'll have more peace of mind if you follow these steps. Successful business owners have three major problems. One, they don't know what to do with their extra cash flow. Two, they're worried about making a mistake with their money. And three, they have a fear of running out of money in retirement or when they slow down. Have you ever felt these things? Lots of concerns, right? And I would guess that as a business owner, you probably feel this way because you don't have confidence in the stock market, and you've maybe even lost money there, or you're worried about the future of the economy and feel that you need to hold on to your cash because of that uncertainty. Or you're frustrated because there's so much misinformation out there about investing and you have no idea what to believe. Well, believe me, I've been there and I know exactly how you feel. These concerns and problems are real, and today you'll get answers. But before we dive into the detail, let me ask you a question. Why would you want a safe place to grow wealth and protect your extra cash flow? As you think about that, consider a couple things here quickly. Where do most Americans save and invest their money today? If you guessed a 401k or IRA, you're right. Since 1974, Congress has approved more than ever the 401k plan as an attempt to fix a broken pension system. The 401k and IRA have become the primary vehicles for saving and investing money, which is unfortunate, and you'll see why. If you know anything about the stock market, you're familiar with the S&P 500 and the Dow Jones Industrial Average. But perhaps you haven't heard about the VIX, V-I-X. The VIX is an index that shows how comfortable investors are with the market. What you need to know is if the VIX is high, it means investors are worried and leery about investing. But if the VIX is low, it means that investors feel good about the market and they're buying. They're comfortable. They don't see any problems. Why is this important? Well, guess where the VIX is today? It's lower than it was in 2007, just prior to the crash of 2008. Now, although the markets have hit record highs recently, did you know that the S&P 500 since 1930 has only returned 5.5%? And you see that in the actual return there that I've circled. And that's before taxes and fees. And if you look in the left-hand corner there, that's 87 years of history. And did you know that the Dow has only returned 5.2%? And again, that too is before taxes and fees. And look, in that left-hand corner, that's 116 years of history. When you subtract the taxes and fees from those numbers, the net return is only around 2%. And why so low, you might ask? I'll answer that question in a few minutes too. Why is this relevant to you right now? Well, what I'm particularly describing here is volatility. We haven't seen a major crash or correction in almost 10 years. The market has been hitting record highs, but why is this happening? Could it be the effects of quantitative easing by the government several years ago? Could it be the overvaluation of stocks? Could it be that investors have forgotten all about the crash of '08? Or could it be that investors don't know what else to do with their money and they're now pumping cash into the market? Or could it be all of these and more? Now, I'm not a doom and gloom kind of guy. I'm an optimist. However, I'm also a realist. And what I'm saying is that it's time to get real about where you're putting your money. So I decided to hold this webinar for business owners because I'm a business owner myself, and I've asked these same questions. And questions like, where do I put my money? Why is there so much conflicting advice out there? Who can I trust when it comes to my money? I talk with hundreds of people every year that don't know what to do with their extra cash flow. I get asked often what they should do with their money. So today I'm going to take you behind the curtain and show you exactly how the top 1% of business owners save money and generate wealth. And my secret is this: no matter what happens in the economy or stock market, I know and teach people 4 primary things. 1, how to grow their money guaranteed every year. 2, how to keep that money liquid. 3, how to protect that money from creditors, lawsuits, and even bankruptcy. And 4, how to use that money now and in retirement completely tax-free. When you have this information and you take advantage of it, I promise it will be incredibly powerful for you, just like it has been for me and my clients. In fact, the right information today will potentially allow you and your family to have millions more than you otherwise would have had. And today I'm going to show you how to create this yourself. So whether you own a dental practice, a gym, a car dealership, a doctor's office, a real estate business, a chiropractic office, a coaching, consulting, or marketing business, a law firm, an online business, any type of business, or anything else that you can possibly think of, this webinar training is for you if you have extra cash flow every month and you don't know what to do with it. Today, I'm going to teach you how to save money and generate wealth like the top 1% of business owners do, in a really great way that makes everyone feel good. In fact, you will see that others just like you are doing this. I'm going to show you exactly how to do it, even if you've lost money in the past. And I'm going to teach you this process by showing you how I've used it with business owners to give them financial peace of mind in 3 real-world case studies. The first example we'll go over is this case study showing how a 31-year-old dentist will turn $875,000 into $2.5 million tax-free. Then I'm going to walk you through the second case study and show you how a 40-year-old chiropractor pays himself interest for equipment loans instead of paying interest to a leasing company, and he generates more wealth along the way. And if you stick around to the end, I'm going to walk you through this case study of a 51-year-old business owner who got started late on his retirement savings, but at the age of 70 will be able to turn $700,000 into more than $1.4 million tax-free and double his money with no worries, no concerns about volatility. So I'm going to take you behind the scenes of these 3 different case studies, and yes, I'm going to show you numbers so that you can see the numbers are real and accurate. And these case studies are for 3 different people with 3 different backgrounds in 3 different business industries. And all 3 of these case studies work really well because they all use the same exact secret that I shared with you earlier, which is guaranteed growth, liquid cash, protected money, and tax-free use of that money. Basically, it's a recipe, and if you follow the recipe, you'll get the results. So let's start with my primary goal for you today, which is to prove to you beyond a shadow of a doubt that every single person on here can do 3 things. You can learn how to safely grow and protect your money without having to worry about losing money ever again. That you can have liquidity and access to your money tax-free without the penalties or fees. And that you can implement this strategy no matter what type of business you own and secure your financial future to be sure you never run out of money in retirement. In addition to my primary goal today, I want to help 2 types of successful business owners. First, business owners that haven't started saving or investing money yet because you're just unsure of what to do. And second, business owners who are saving and investing right now, but you're unhappy with the results. If you're one of these types of successful business owners, you'll get valuable information that you can act on immediately for much better results with your savings and investments. Why is this important to you? Learning how to do this will change your life forever. And by change your life, I mean that you'll never have to worry about losing money again. When you have the ability to grow and protect your money year after year, you have the ability to know what your future will be. No more crossing your fingers and hoping for a positive outcome. Today's training will give you confidence about saving and investing money just like the top 1% do. I struggled as a business owner for years, and when I did have extra money, I invested that money in all the wrong places. Does that sound familiar? But I had no idea at the time that they were the wrong places. And then I learned about this, what I'm sharing with you today. And within a few short years, I had built a very successful business. And hey, by the way, before we go on, if you haven't done so already, please make sure you close down Facebook or anything else that is distracting you. And be sure to have a pen and paper handy to take some notes, because you'll definitely want to. I hear from business owners that they don't know what to do with their extra cash flow. So in addition to those 3 case studies, I'm also going to share with you one additional secret: how to avoid the 4 biggest investing mistakes that most business owners make. So again, stick around to the end because you'll want to learn about these 4 biggest mistakes. In total, it's probably going to take me around 90 minutes or so to go through everything, so please make sure you're paying attention. Now, as for my qualifications when it comes to teaching this topic, I've been in the financial services industry over 17 years. I've been a business owner since I was 16 and first became a millionaire in my early 30s. I also have a 14-year real estate background, and I ran over $90 million of business through one of my investment companies in Las Vegas. And my company today, Focus Wealth Group, is doing business in 49 states throughout the U.S. I work with hundreds of people every year, just like you. I love to teach. I have personally invested in almost every type of investment out there. I know what works and what doesn't work. Today I'm going to share with you the same system and financial principles that I use to build these very successful companies. Today what I do best is teach and assist clients in growing and protecting their money. Here's what my client Tim from Nebraska had to say. He said, "I learned about the concept as a component of wealth building. It made sense to me as a way to safely compound my wealth without significant correlation to the market. It is also tax advantage. I'm now allocating a significant portion of my portfolio to it over the next several years as the market becomes more toppy. Barry's easy to work with because he comes across as always working in the interest of his clients. He takes time to explain important concepts and is very transparent about the whole process. I enjoy doing business with people of high integrity like him. I would encourage people to approach this system with an open mind to see if it makes sense in their quest for financial security." That's Tim. And here's Johnny from Las Vegas. He says, "Over the years of learning the hard way is the main thing that helped me choose this system. Being that I tried the traditional methods recommended by the so-called experts, which guaranteed them profits via commissions and fees, with me taking all the risks and losing more than I could possibly win. My frustrations caused me to look for a better way. Fortunately for me, I received a tremendous amount of education and guidance from Barry concerning the truth about this strategy. As a result, my family and I now enjoy freedom and security for the short and long term." So thanks, Johnny, for that. The success I've had in being able to teach this to hundreds of people across the country, it's been very rewarding. It's allowed me to mountain bike when I want and play guitar and golf here in southern Utah. I love doing those things, but what I'm extremely grateful for and love most is my family and the little things, having the freedom to see my kids off to school or taking a family vacation in the middle of the work week. Financial freedom is more than money. It's about having the time to spend and enjoy the money we make. And for me, Knowing that the money I save and invest will grow every year and that it's protected gives me peace of mind that I didn't have back in 2001 when I was so worried about losing money. Anyway, now that you know a little bit about my background, is this material and training session today going to be useful and relevant to you? Who is this for? If you make your income through a business that you own, then yes, this is especially for you. If you are a business owner who has extra cash flow every month, who wants to grow money like the top 1% and generate more wealth, then yes, this is for you. And if you've lost money in the past, we will solve that problem once and for all, then yes, this is especially for you. This is for successful business owners that know they are good at what they do and make at least a six-figure income doing it. This is for business owners that want to grow and protect their hard-earned cash and truly value protecting their families, their business, and their legacy. And finally, if you want to learn how to have a stream of tax-free income in retirement that will allow you to create financial peace of mind, then today's training session will show you exactly how to do that. Now, with that being said, I have some house rules before we dive into the content. If you have a get-rich-quick mentality, or if you're looking for some kind of do-nothing type of miracle sales gimmick that will just magically make you rich, I'm sorry to say that you will not find that here nor anywhere else because it doesn't exist. I'm going to teach you financial principles and strategies today that work as you apply them and implement them. This is not a get-rich-quick scheme. The process I'm going to share with you today works as well as it does because it's based on honesty, transparency, and empowerment for you, the client. Unfortunately, this formula can also be used by bad people to do bad things. If you are someone who wants to manipulate or take advantage of people for your own personal benefit, this is not for you. You can leave now, and ultimately the only way to get what you want in life is to provide value to others. I think it should be fairly obvious too, but I'll say it anyway. Actual results may vary. It took me years of study and hard work to figure this out and to master this process. While I can give you a massive shortcut today, you will ultimately have to dedicate time to learn. You'll have to decide, are you serious? And if you are, I promise that what I teach you will be of great value to you. But I don't have control over your decisions and actions. I can only teach you what I have learned over the last 17 years. I know things about money and investing that most people don't know. Following our theme of honesty and transparency today, we both know that the vast majority of people who buy a book never read it, who watch a webinar never implement it. Just as most people who bought a Bowflex have it sitting in the garage collecting dust, you must take action in order to get results. People say they want the end result, but at the end of the day, they're simply not willing to put in the time or work to make it happen. The ones who do get the reward. All right, so if you're still with me after that little rant, let's dive in and keep learning. All right, so if you're still with me after that little rant, let's dive in and keep learning. Right now, I'm going to show you how to save and protect your extra cash flow and generate wealth just like the top 1%, which will enable you to create and have financial peace of mind. The first thing you need to know about saving money and generating wealth is that there are certain characteristics that must be met in order to achieve this. In essence, you can think of it as the perfect financial strategy. It works for you 24 hours a day, 7 days a week. It never gets tired. It has the ability to enhance whatever you're currently doing with your money right now. And the perfect financial strategy guarantees that you never lose money. You remember what Warren Buffett said? And finally, It has the ability to give you 30 to 50% more spendable income in retirement, and it works every single time. So what's really important here is that this perfect financial strategy is completely automated. It doesn't require you to constantly be checking your investments or meeting with a financial planner to rebalance a portfolio. And that's the key. Putting this perfect financial strategy in place so that no matter what happens in the market or economy, your extra cash flow is secure. It's why not having the perfect strategy in place has caused business owners to lose money in the past. And before I figured this out, my life looked completely different. Back when I made this realization, I had a very different motivation that inspired me to start figuring this out. It was 2001, and I had a financial mentor. He taught me about money and investing. He showed me charts and graphs and historical data of investments. It looked so amazing that I not only started working with him as a client, I also started building a financial business with him. He told me what to do and what not to do when it comes to investing. He was very successful, and at the time I really appreciated his advice. What he told me was that the best place to grow wealth was in the stock market. And growing wealth and becoming financially free was exactly what I wanted. Like you, I wanted to make more money and provide well for my family, so we could all enjoy life more, more traveling, better vacations, and a lot more financial freedom. But what I didn't realize at the time is that my mentor was completely wrong. He didn't teach me about the downsides of investing. It was all hyped up. And I found out that what most financial advisors sell to their clients is a lot of hype. They don't talk much about the downside and the huge risks their clients are taking. They don't talk about the massive losses that people have. And I figured this out the hard way. After putting a lot of my personal money into the stock market, I lost it. And a lot of my clients lost a lot of money in the stock market too. I didn't know what I was doing because I simply took the advice of my mentor, who took the advice of his mentor, and so on and so on. And ultimately, we were just salesmen for the stock market industry. I was selling for Wall Street, IRAs, mutual funds, all those types of unstable investments. I had heard for years that people got rich in the stock market, and I tried investing in many different types of market-based investments, but nothing worked. It didn't work for me, and it didn't work well for my clients. And as I discovered over the next few years, it wasn't working for the vast majority of people either. The advice from one company was to buy conservative mutual funds, and then the advice from another company was to buy aggressive mutual funds. And the advice from another company was to go with variable annuities, while yet another company's advice was to figure out your risk tolerance and take a test and diversify over many different industries. Have you been through that little exercise before? This was all so confusing. And this confusing advice, it still goes on today. And I was fed up with all the confusion. I had lost money and I was done. There was no way I was going to keep going down this path. So I started to explore all kinds of different investing strategies. But no matter what I did, I always ran into the same problem. I was always told in a roundabout way by a financial advisor to relinquish control of my money, to give it to someone else that claimed they would grow it for me. And the problem was there were never any guarantees, and I hated to not be in control of my money. I'd been burned before, and I wasn't going to give up control. I started to think that, maybe I just wasn't cut out to be an investor. And if you've ever felt like this, there's a reason. This skill set wasn't taught to any of us. We're not offered a course called How to Become Successful Investors in school. So don't be hard on yourself because this isn't common knowledge. Again, I've learned things and know things that most people don't know. You have to seek it out, which is exactly what you've done here today. You can do this. The big investment companies want you to believe that you have to relinquish control of your money. They want you to think that you need to invest with them or have some fancy college degree to be successful. And I'm here to tell you they're wrong. They have their own reasons for wanting you to think this way. They want to continue to keep you in the dark and scrape money off the top for themselves. They want to keep you believing that you need them in order to be successful. But that isn't true. Picture yourself driving down a foggy road. You soon see a man on the side of the road waving you down to stop. He tells you that just up ahead the bridge over the canyon is out, and that if you keep going, you will plummet into the canyon below. What do? Some people take his advice, but others ignore him because they don't believe it. You see, I've been down the road of traditional saving and investing, and I'm here to tell you that the bridge is out. Most traditional investment strategies don't work. They leave people in a worse position and leave the financial advisor in Wall Street in a better position. And it isn't fair and it isn't right. So while I hated relinquishing control of my money, I hated even more the thought of not being successful at saving and investing money. So I kept hacking away for several more years. And finally, 7 years ago, I reunited with a friend who became a great coach to me named Mike. He started to teach me how to have control of my money. He taught me about my number one asset, my number one investment, and my number one strategy. And I'll get to those in a few minutes so I can share them with you. But what I still couldn't figure out along the way is why so many other people were still putting money into the market after a major crash. We saw that after 2008, people were still putting money in the market, and you'd have to be foolish to do so. I had just experienced what losing money felt like. Why were so many people still taking the advice of financial advisors in Wall Street? Why were so many people dumping piles of cash into their 401k or IRA? It just didn't make sense to me. And then after years of putting the puzzle pieces together, I figured it out. Now this will sound too simple to you, so simple in fact that you probably won't believe it. What I figured out was that it really came down to marketing. It's marketing that has deceived us. We've been sold and educated on financial advice marketed to us by the billion-dollar powerhouse investment companies, that when we give our money to them, they'll make us rich, right? You've seen the commercials and read the ads that these investment companies put out there. They are very enticing. They almost make you believe that if you give your money to them, you'll be rich. But it doesn't work. And I've experienced it firsthand. I've also had the privilege of talking to thousands of people over these last 17 years who have invested their money in the market. I've heard their stories of losing money. I've listened to their devastating experiences. To this day, I'm constantly having to fight back against the half-truths told by Wall Street and financial advisors. You might be thinking, Barry, what does this story have to do with me? Well, I know a lot of people that are investing money in the stock market, and they don't know what they're doing either. You might be one of them. I want you to learn from my mistakes so that you don't have to go through the pain of losing money like I did. And I want you to grow more money. You and many others have been told half-truths by Wall Street and financial institutions. Let me give you an example of a half-truth used by typical financial advisors. A common half-truth is what's called an average rate of return. An average rate of return is calculated by taking the return in a given year and then dividing it by the number of years that you want the average rate of return for. Here's what I mean. They'll take whatever the market earned in the given year, in this case 10 years, and you see year 1 at 7%, year 2 at 3%, year 3 is negative 18%, and so on. They add up all the numbers for these 10 years, which comes to 50, which you see here, then divide it by 10 years, which is 5%. So 10 years, it's an average 5% rate of return. And as you look at the average, do you see 5% in here anywhere? No, it doesn't exist. So one thing to be aware of is just because the market averages a certain return, it doesn't mean that's what you're going to actually earn. And again, this happens because of volatility. The markets go up and the markets go down. When people invest in a 401k or IRA, they are sold most often based on an average rate of return. John Bogle, he's the founder of the Vanguard Group, said that the U.S. retirement system, quote, is almost rigged against human psychology that says if something has done well in the past, it will do well in the future. Bogle told that to Frontline. Quote again, he said, that is not true. That is categorically false, he said. Bogle here is describing volatility, the ups and downs of the market, which is just one of the three eroding factors of wealth. The other two are fees and taxes. But regarding volatility, here's another example. When a mutual fund or stock is sold, it's sold with a historical rate of return, meaning what has that stock or mutual fund averaged over the course of the last 5, 10, 20, or 30 plus years. It's that example I showed you earlier, 50 divided by 10 equals 5%. And it's the financial advisor giving us those numbers. Today I want to share with you what that really means. If you have a portfolio of, let's say, $1 million, let's make an assumption that the million has a 100% rate of return in the first year, and it takes your $1 million portfolio up to $2 million. It looks great, but what happens if in the second year you lose 50%? You're back down to the same million that you started with. However, year 3, you have another great year with a 100% rate of return, and you're back to $2 million. But unfortunately, in year 4, your portfolio drops again by another 50%. Well, what's happened? What does this really mean? At the end of the 4-year time frame, you have the same million that you started with. So think about that. 4 years have gone by, and you have the same $1 million. Watch this. I'm going to click on this button here, the Show Rate of Return button. You see, financial advisors in Wall Street would tell you that you had an average rate of return of 25%. They'd say, look, you're a phenomenal investor. You averaged a 25% rate of return in your portfolio. Yet you're looking at your balance and saying, wait a minute, I have the exact same $1 million that I started with 4 years earlier. Your actual rate of return is 0. And this is the funny math that gets used in the world of financial advising in Wall Street. They use this type of math to convince investors to invest with them. And frankly, again, it doesn't work. Now, you might think that my example here is being exaggerated. You know, who has 100% return and then loses 50, back to 100, loses 50 again. Well, take a look at this. This is the S&P 500 index, and notice that back in 1997, there was an aggressive increase of 106% through 2000. And at that peak in March of 2000, the S&P began to drop dramatically. And now you see this 49% decrease over the next 3 years. Then October 2002, it began to climb again, 101% return. Then, as we all know, in 2008, the crash began, and the S&P 500 lost 57%, bottoming out in March of 2009. Well, look at the trajectory the S&P 500 is on today. It has climbed and risen to a staggering 249%. That doesn't mean you're earning 249%. That's just the difference of where it was at in 2009 versus today. The markets are at all-time highs, and what does the future hold? We're just not sure. But the U.S. is $20 trillion in debt. Social Security nearly has more going out than coming in. The pressure of Medicare and Medicaid costs, and ultimately there are only 2 options really the U.S. has. Either the government can stop spending on their programs, or they can increase taxes to take care of all these unfunded liabilities. And experts have said that taxes would need to double in order to meet those unfunded liabilities. So as you look at this S&P 500 chart, my example of 100% return and 50% loss, it's no exaggeration. This is reality. And now the S&P 500 is on this climb. And who knows what the future holds? Will it continue, or will there be another major crash or correction? So consider where you're putting money today. Are you at risk? Or do you have certainty and predictability? The next time you hear a financial advisor or some television commercial promoting financial advice, using the word average, it should be an immediate red flag to you. This is one of those half-truths that are told. And the big problem is that this is how most investments are sold. This is how I was sold. And when I went through the experience of losing money, it hurt. I lost countless nights of sleep. It affected my marriage and my family. It was extremely painful, and I don't want you to have to go through those same disastrous things that I did. And back then I had two choices. I could lie down and quit, give up and forget all of it, which is what I wanted to do many times, or I could fight my way through it and do my best to figure out what in the world did I miss, and how did I wind up in such a bad financial position. I chose to fight. And I want to share my experiences with you. I know things about the financial world that most people don't. What I'm about to share with you comes from a deep desire to tell others what Wall Street won't tell you, and what most financial advisors won't tell you. I want to help you and other business owners like you. So when I went through that experience of losing money in the market, I chose to fight. I started on a very grueling journey, a journey of discovering not just something better, but something different. I was on a mission to discover something completely opposite of the stock market. And here's another reason why. If losing money wasn't enough for me, I wanted to also figure out what the other problems were with traditional investing. In addition to volatility, there are fees that erode your money. Take a look at this. Many people don't realize the amount of fees that they're paying in a qualified plan. A 401k, a 403b, an IRA, or a similar qualified plan, and even straight mutual funds. What I want to show you today are some of the issues with fees and how the fees can erode up to half of someone's account portfolio. I'm going to start off really simple here. Assume that this person is 35 years old and they want to save money for 30 years, up to the age of 65, and they want to have $1 million. So the question is, what would it take a person to save every year to accumulate $1 million if they were just putting this cash under their mattress? So for 30 years, they would need to save $33,333. And at the end of a 30-year time frame, they would have $1 million, as you see here. Now, I'm using this example because it's very simple to see what happens with fees. This is cash under a mattress that over 30 years became $1 million. There's no interest that was earned on this, just straight cash under a mattress. So let's assume that this money had been put in a 401k or a mutual fund, and now there was a 2% fee that would have been charged on this money. So up in the right-hand corner, you see the 2% fee. And we're looking at this now as if there were no interest earned. A 2% fee drops the account to $742,000. That's more than a 25% reduction in the overall account value. Does that shock you at all? That a 2% fee erodes 25% of the cash? Now you might be saying, Barry, a 2% fee is too high. And others of you are saying, wow, only 2%? I'm being charged much more than that. Well, to be fair, take a look at this Forbes article. This is an article titled The Real Cost of Owning a Mutual Fund. And in this article, the author talks about the expense ratio that's charged, transaction costs that are charged, and then goes on to talk about tax costs, cash drag, soft dollar cost, advisory fees. And the conclusion you see here, in a non-taxable account like a 401k or an IRA, the net cost for fees is 3.17. And in a taxable account, the fees are 4.17. Again, I'm only using 2%. When people put money into a 401k or a mutual fund, they're obviously expecting some type of return. But what's interesting about this is that the higher the rate of return, the greater the fees. I'll show you what I mean. So you notice they're up in the right-hand corner. The fees are back down to zero. So let's assume now that this person earns a 6% rate of return every year, year in and year out, which hasn't happened consistently in the market, but let's look at it as if it did. Now we see that the total account value grows to $2,793,000 down here in the right-hand corner. But if we add that same 2% fee back in, the account now drops to $1,900,000 $903,000. So let's do the math. If you take $1,903,000 divided by the number without the fee, which was $2,793,000, we're talking about a 31% reduction in account value. A so-called small management fee of 2% over that 30 years results in a drop of almost $900,000. This person loses $900,000 because of fees. Remember, that was a 31% loss. What if the return was an 8% return? So again, we take the fee out. The account would grow to just over $4 million, $4,078,000 to be exact. But with the 2% fee, now the account drops to $2,711,000. And if we do the math on this, now the account has eroded 34%. So as you can see, the higher the rate of return, the larger eroding factor of your money because of the fees. And why is that? If there are more earnings, that means that there is a greater amount, a greater volume of fees that are being charged. It's still the same 2%. But if you notice here in, say, the 7th year, the 2% fee took away $6,000. But notice what happens. As the account value gets higher, so do the fees being charged. By the time you get down to even the 15th year, you're being charged $16,000 of fees. Those are deducted from the account. Then you get down to the 28th, 29th, and 30th year where you have over $48,000 in fees. And that just keeps growing. This isn't just happening one time. This is happening every single year. It's why at the end of this 30-year time frame, there's a difference of $1,366,000 in value because of fees. You lose that amount of money. Then you tack that on top of lost opportunity costs. In other words, what could you have done with that extra money? That factors into your losses as well. And not only has Forbes addressed the issue with fees, but so also has Bloomberg, Dalbar, and 60 Minutes, and many others. I want to share just a quick portion of the 60 Minutes story that they did on fees in these qualified plans. It's less than 3 minutes, but you're really going to enjoy it.
Brooks Hamilton has helped design retirement plans for some of the country's largest corporations. He says 401ks turned out to be so much cheaper than funding pensions that many companies decided to freeze their pension plans and replace them with 401ks. The decision created millions of new employee investors for Wall Street and the financial community, and they pounced on the opportunity.
If you go back and track the mutual fund growth in assets, and you track the growth in 401k plans, it looks like a railroad track leading to the sky. They are parallel tracks.
So the big beneficiaries were the mutual funds.
That's right. That's correct.
When employers began turning 401ks into retirement plans, the financial community was not shy about promoting them as such. The prospect of trillions of dollars in the hands of unsophisticated investors opened the door for all sorts of potential abuses.
The fact is that the typical 401k investor is a financial novice. They don't know a stock from a line. And we give them a list of 20 or 30 mutual funds with really, really powerful names. They sound like, gee, that's where I want to have my money.
What are generally the quality of the mutual funds and 401k plans?
Mediocre. I'm going to be real honest with you. With half the funds on the list, really dogs, what people would characterize as dogs, shouldn't be on the list to start with.
There clearly has been a raid on these funds by the people of Wall Street, and it's cost the savers and the future retirees a lot of money that would otherwise be in their account, independent of the financial collapse.
Representative George Miller of California is chairman of the House Committee on Education and Labor and a staunch critic of the 401k industry, especially its practice of deducting more than a dozen undisclosed fees from its clients' 401k accounts.
Now you got a bunch of economic wizards jumping in and taking money out of your retirement plan, and they don't want to tell you how much. You can't decipher it in simple English, and they're not interested in disclosing it or having any transparency about it.
And most of the people that look at their 401ks have no idea that these fees are being taken out.
No. Where would you find it? Where would you find these fees in this prospectus? You can look on any page you want, and when you're all done reading, and you will find some of the fees and the commissions here, but you won't find them all, and I bet you won't find half of them.
There are legal fees, trustee fees, transactional fees, stewardship fees, bookkeeping fees, finder's fees, and the list goes on and on. Miller's committee has heard testimony that they can eat up half the income in some 401k plans over a 30-year span, but he has not been able to stop it.
In that 60 Minutes story, you heard that many of these fees legally don't have to be disclosed. Does it seem logical that the larger your portfolio grows, that the larger the amount of the fee? In other words, does it seem all right to you that if you have accumulated $1 million or $2 or $3 million in a qualified plan or a mutual fund, that you should be charged 55, 65, 75 grand a year for that fund to be managed? It just doesn't make sense. Yet we overlook it because it seems like such a small fee, but in reality, it can erode up to half of someone's portfolio. There are other stories you can look at. This is not just exclusive to 60 Minutes. So understand what's happening with fees and the devastation that they're causing to Americans' retirement savings. There is a solution. You don't have to subject your retirement to these kinds of fees. You know, wealth is never destroyed. It's only transferred from one person to another. And this is an example of that. These fees being charged feel like your wealth is being destroyed, but in reality, your wealth is just being transferred to someone else. This is why I was on a mission to find something opposite of Wall Street and that was guaranteed, protected, and predictable. No more of this volatility or the ups and downs of losing money. And I wanted to find something that would really give someone financial peace of mind. And I did. I found something that would change my life forever. It took me years to discover, and along this journey, I not only discovered the solution, but I also discovered that many wealthy individuals have this same strategy in place. And one of the things that the wealthy have done is that they have built a solid foundation, just like building a home. The first thing that's done before the walls go up and the roof goes on is that a solid foundation is set. And the solution that I discovered is designed the same way. It starts with a solid foundation. And this foundation provides guaranteed returns, annual dividends, tax-free growth, cash that is not affected by market volatility. It enables you to take out money whenever you want, provides protection against creditors, lawsuits, and even bankruptcy. There are no contribution limits. You can invest as much as you want. It provides capital preservation without risking principal. You can use it as collateral. Provides monthly revenue in the event of a disability. It allows you to be your own bank, to buy real estate, to invest in your business, or go on vacation. Virtually no age restrictions and no early withdrawal penalties. And the money can be used 100% tax-free. You can see why the Wall Street Journal calls this the tax shelter of the rich. All these benefits, all these advantages are found in this solid foundation, this solution. Imagine having a foundation in your life that took care of all these things. This unique system is built on the foundation of cash value insurance. Now I know there are some myths around cash value insurance, but I'll dispel those myths today. You can solve problems and safely grow and protect your money at the same time, just like the top 1%. So whatever you think about insurance, I can assure you, you've never seen it like this before. Be patient. Most advisors don't even know about this either. Continue to see through this presentation these amazing benefits and the case studies that we go through. My clients and I get all these benefits and more. I want you to know that our money is growing, and it's been growing for years. We've never lost money with cash value insurance. And once I discovered this, my life would never be the same again. And once you acquire this knowledge, the same will be true for you. So what's the secret? How can you safely grow and protect your money year in and year out, just like the top 1%? It really comes down to two things: guarantees and structure. It's saving and investing specifically designed to generate wealth. Think of traditional investing. There are no guarantees. A 401k, an IRA, a mutual fund, or stock, doesn't have a guarantee. It's no coincidence that people lose money. It's a gamble. But with a guarantee, there is no gamble. And look at this social proof. You know these companies. They use cash value insurance as a financial foundation. They want those benefits we talked about. They want the guarantees, and they get the guarantees. So we're going to dive into those guarantees now. This is the good stuff. This information could literally be worth millions and millions of dollars to you and your family, just like it is to these companies. So listen up. And before I forget, this is critical. When it comes to saving and investing money, you have to understand what you're really getting. And this analogy will help you do that. Write it down. No one buys a drill because they want a drill. They buy a drill because they want a hole, right? No one buys a gym membership because they want to go to the gym. They buy a gym membership because they want to be healthy and feel good about the way they look in the mirror. No one purchases an investment because of the investment. They purchase the investment because they want to make money. The problem is that most market-based investments, they don't have guarantees. The odds are not in your favor when you put money into a non-guaranteed investment. Remember the numbers earlier I gave you about the S&P 500 and the Dow. Why only a 5% return? It's because there are no guarantees. Look at this. This is a volatility chart with standard deviation. How do you plan for your future in a system that looks like this? If your end goal is to make money, you have to have a strategy that will guarantee you make money. And cash value insurance is the product out there to do just that. It allows you to safely grow and protect your money. It allows you to get guaranteed growth on your money year after year. It's a way for you to invest in assets that never stop growing. It's a way to safely build tax-free retirement income. And you can leave a guaranteed legacy to your heirs. Okay, so here's what we're going to do. We're going to look at the first case study. This is a 31-year-old dentist that will turn $875,000 into $2.5 million completely tax-free. That's $2.5 million of tax-free income. Let's see what he's doing. He's putting $3,000 a month into the policy, plus $38,000 up front. He had some extra cash and wanted to get that working for him immediately. If you look then here at the total annual outlay, you see his money going into the policy through the age of 54. Now what you'll also notice here is that he has total net cash value. This is his money. He has access to use this cash for whatever he wants. During this time frame, this money is completely liquid. And he also has a death benefit. And you notice the death benefit is growing. Every year it gets larger. That gives him protection for his practice. It protects his family. He can use it as collateral. All those things we talked about. Now there's a myth about cash value insurance that when you die, the insurance company keeps the cash value. That is not true. The initial death benefit on this policy was $1.3 million, which you see here. But as I've shown you in this right-hand column, the death benefit is growing. Well, why is that? It's because this policy has been structured correctly with high cash value. The insurance cost in this example is very low. Unlike a typical insurance policy, the focus here is not on a large death benefit, but rather high cash value. And in a properly structured policy, you get both cash value growth and death benefit growth. The myth that the insurance company keeps your cash value is not true, but you must have a properly structured policy in order for this to work. So he decides at the age of 55, he's going to stop putting money into the policy and retire early. At that point, he would have put in a total of $875,000. His $3,000 a month times 12 times 23 years plus his initial $38,000. And you notice here, at the age of 54, there's 1.4 million of tax-free money that he has access to. This money could keep growing, but he chooses to take income at age 55. This is flexible, however. When he gets to 55, if he chooses to keep putting money in, well, then the cash value will continue to grow. But in this example, he retires early at age 55, begins to take $85,000 a year for 30 years. That's 30 years times 85,000. So 85,000 through the age of 84. 85 times 30 years, it's $2.5 million tax-free. And if he happened to pass away, he's still able to leave a $721,000 death benefit to his heirs, tax-free. Now, this is just one example. There's all sorts of flexibility inside the policy, but you can see here clearly that an $875,000 investment of his money into the policy allows him to take $2.5 million tax-free. And you know, that $85,000 tax-free in a 35% tax bracket is going to spend like $130,000 taxable. So think about that. Compared to an IRA or a 401k, you have to pull out $130,000, pay the tax to net the $85,000. Some points again to reiterate. His cash value could be higher than this if he wanted to keep going. He could wait to start taking income at a later date. The flexibility I shared with you. You know, and how is it possible that he can get more out of the total cash value? Remember, at the age of 54, there was 1.4 million of total net cash value. That was his money. But he's able to take out 2.5 million tax-free. That's because in a cash value insurance policy, when you take a policy loan, the life insurance company does not physically remove the money from your cash value. They put a lien against it. So you're still able to earn interest and dividends on your full cash value. So he can take more money out than is actually shown. It's a huge advantage in a life insurance policy. You're never required to pay back a loan. And in retirement, when you're taking that income, you shouldn't pay back the loan. The outstanding loan is simply reduced from your total death benefit. Now you might be asking, what about the cost? You said it was low, Barry. What about the cost? In a cash value policy, there are no additional fees that you're billed for later. You simply make your premium payment and that's it. So if you decide to put $3,000 a month into a policy, $1,000 a month, or $10,000 a month into a policy, that's entirely up to you. You'll never pay more than your premium. So as I've showed you in this case study, the cash value that you see in this total net cash value column, it's net of any fees. This truly is your money. This policy is earning compound interest. Unlike a stock or a mutual fund that's volatile and will go up and down with the market, cash value insurance grows at a consistent, guaranteed rate. And that money compounds. Once a dividend is paid, you can never lose your dividend. So as you see here with compound interest, you never have to worry about losing money. It grows and grows. To keep it simple, let's say you have $500,000 here in cash value, and you want to take a policy loan for $100,000. When you take a policy loan, the life insurance company does not physically remove the money from your cash value. So although you have a $100,000 loan, you're still earning interest and dividends on the full $500,000. You never break the compound growth curve. Unlike a savings account or a stock market investment or a CD, when you take the money out, it's gone. It's no longer working for you. But in a cash value policy, you get the best of both worlds. You're able to use the money and you have the money working for you still inside the policy. You might be asking, well, what about the cost? In a cash value policy, there are no additional fees that you're billed for later. Robert Kiyosaki taught a lot of principles in his book, Rich Dad, Poor Dad. One of those principles he taught was to pay yourself first. This is a rule that the wealthy live by. It means whenever you make money, set aside money for yourself first before you start paying your bills or other people. When you set money aside in a cash value policy, you are paying yourself first. So how much of your income should you set aside and put into cash value insurance? The general rule is 10 to 20%. There are clients I work with that set aside more than that because they want more tax-free cash in the future. But you choose. Set aside a dollar amount, and the more you set aside, the more you'll have. Now let me show you how to pay less for a cash value insurance policy to keep the costs low. And this is what I mean by a properly structured policy. In order for a cash value policy to work correctly, where you can outperform the market and use the cash as your own bank, the policy has to be structured correctly. This proper structure enables a client to have a lot more cash value in the early years of the policy and throughout the life of the policy. And it also lowers the cost. That's a big myth out there about cash value insurance, is that it's expensive and agents earn massive commissions. That isn't true when it's structured correctly. I actually lower my commission and reduce that commission by 50, 60, 70%, and my clients have much higher cash value. In all cash value policies, there's what's called base premium. And you can think of this as kind of the minimum amount to keep a policy in force. Now there's another myth out there about cash value insurance, and that is that you have to make a premium payment your entire life. That is not true either. You could fund a policy for 10 years, you could fund a policy for 25 years or 40 years or even 8 years. There's all sorts of flexibility. So don't believe that you have to fund a policy your entire life, because that is not true. But the problem is that most agents out there will take all of your premium and only put it into base. So if you're going to set aside $2,000 a month or $10,000 a month, whatever that number is, most agents out there will take every dime of your premium and only put it into the base. And what happens is you end up purchasing a large amount of life insurance death benefit that you'll never use until you pass away, and it goes to your heirs. So that type of policy feels very expensive. It feels like you're only paying for life insurance, because that is primarily the case. I call these types of policies that are all base premium less efficient and less effective. There's $0 of cash value in the first year and very little cash value growth in the early years of the policy. There's a better way to structure these policies. The structure that I use enables clients to have much more cash value. I use an overfunding rider called paid up additions. Or PUA for short. It's a paid up additions rider, and it is the overfunding of your policy. This overfunding of the policy, instead of all your premium going into the base, we want to see the majority of your money going into the overfunding. At least 2/3 of it going into overfunding. And what that means is that you have immediate cash value in the very first year. Right off the bat, you'll have 60, 70, perhaps 80% of your money immediately available to you in your own cash value. And that's the goal. We want high cash value. Now your costs are low. We've maximized the cash value, and that means every year thereafter, your cash value is growing much more rapidly. It's growing on a guaranteed compound interest growth curve. This is the proper structure. Again, most agents don't know about this. Those that do would rather not reduce their commissions. I want to be sure that my clients are getting the best policy right from the start. And when you have a properly structured policy, you'll have many more benefits than you otherwise would have had. Now, before I go on to the second case study, I want to introduce you to this guy, Mark Ford. Mark is the co-founder of the Palm Beach Research Group. He's done very well and has grown his business into a multi-million-dollar venture, along with a lot of real estate holdings. Mark had this to say about the investment industry. Quote, The investment advisory industry, and by that I include brokerages, private bankers, insurance agents, as well as investment newspapers, magazines, newsletters, and interpublication, is a huge multi-billion-dollar business based on hard work, clever thinking, and sophisticated algorithms, but also on one teensy-weensy lie. The lie is that you can grow wealthy through investing in stocks and bonds. Isn't that amazing? Mark Ford, who is a part of this industry with his financial newsletter, says that people do not grow wealthy investing in stocks and bonds. What do the wealthy do? Mark goes on to say, their primary focus, meaning the wealthy, is on increasing their active income. Usually this comes from a business they know inside and out. They invest in real estate and other outside Wall Street opportunities. How do you focus on increasing your active income? I'm going to show you. This is what I learned from my friend Mike. Think about your number one asset, your number one investment, and your number one strategy. If I ask you what is your number one asset, what would you say? Are you thinking about your house, your 401k, your safe full of gold and silver? Are you thinking about things that we call property value? Now ask yourself this question: what is my number one asset? You're probably thinking of those answers like most people, and how the traditional planning world teaches us to think about this, which is a conversation around property value, PV. If you think of property value as a balance sheet, assets and liabilities, you have a home, you have your business, you have cash, you have retirement accounts. It's all centered traditionally around property value being the number one asset. However, we all have human life value, HLV. And human life value is our mental capital. We have assets that are unique to us: our education, our experiences in life, our skill sets, our knowledge, morals, values. Recognize that human life value is the source and creator of all property value. Without you taking action to learn, to improve yourself, to make yourself more valuable, there is no property value. Your number one asset is you. Be more deliberate than ever about increasing your human life value, knowing that it will put more property value into your pocket, more money. Continue to invest in yourself and make yourself more valuable. Now ask yourself this question: what is my number one investment? Your number one investment is not a 401k, an IRA, or a brokerage account. It's not that gold or silver sitting in your safe, or oil or gas investments. Your number one investment is in your own business. Your business makes you the most money. I'm sure that you would agree. Your business is your highest rate of return. Invest in your business. I see too often business owners getting distracted by the bright, shiny objects, the outside investment opportunities they don't know much about. They lose money and they've been distracted from their business. Focus on your business. It is your highest rate of return. Now ask yourself this question: what is my number one strategy? Whenever I share the answer to this, I clarify that if you're going to invest outside of your number one asset, which is you, and your number one investment, which is your business, then you must be sure that those dollars meet 4 criteria, which is that money must be guaranteed, liquid, protected, and tax-free. So think about it. You already know your business is your highest rate of return. If you invest outside of your business, make sure those dollars are guaranteed, liquid, protected, and tax-free. So when I ask you the question, what is your number one strategy? Whatever you're thinking of, does it meet these 4 foundational characteristics? Your number one strategy is cash value insurance. It's your own banking system. You can then coordinate these cash value dollars to invest back into yourself, your human life value, and back into your business. And keeping that money in motion creates more wealth. Cash value insurance meets all 4 of these foundational characteristics: guaranteed, liquid, protected, tax-free. Plus, it gives you all the benefits I mentioned earlier. Whatever you believe about cash value insurance, you must look at it from the perspective of facts, not opinions. When you focus on your number one asset, your number one investment, and your number one strategy, this is how you increase your active income. Invest in yourself. Invest and focus on your business because it generates the most money for you and is your highest rate of return. You then coordinate your cash value insurance to be used to increase value in yourself and your business. All right, let's get to case study 2. In this example, we are going to be looking at a 40-year-old chiropractor, and he's going to pay himself interest for equipment loans instead of paying interest to a leasing company. You know, what I see with a lot of business owners is that they lease equipment, and that's okay because they are looking at the payment on the lease and the amount of money that the equipment is going to make them, and it's much more than the payment on the lease, so it makes sense to lease the equipment. The problem is most leases on the back end, you don't realize, you might be paying 8%, 12%, 15% interest on that lease. So the point is, what if you had a system set up where you could pay yourself the interest instead of paying that interest to a leasing company? So here's an example. This particular client is setting aside 10 grand a year into a cash value policy. And you see that here in the total premium column, 10 grand a year. Over the course of that time, they have access to the cash. This is access to cash, total cash value. Now we've got to take a side note here for a minute. If he does nothing else but put 10 grand a year into this policy for 10 years, at the age of 65, he has $300,000. That alone is a 5.37% rate of return. Using my calculator here, you see it's the same 300 grand in 25 years, 5.37%. That is a tax-free 300 grand. What that means is that you would have to earn 9.31% every single year for the same 25-year period in the market without ever having a single down year. That's amazing. You can see how good this cash value policy is by itself. Well, we're going to make it even better. In year 1, there's $6,200 of cash value available. Again, this is using the proper structure that I just went through. Because of that overfunding of the paid-up additions, instead of $0 here, there's over $6,200 in year 1. Well, let's say in year 5, he wants to take a loan for $15,000. And he can, because he's sitting on $47,000 of cash value. And he wants to use this loan to buy equipment. Here's the $15,000 loan. And instead of leasing the equipment from a leasing company at 8% or 15% interest, he can take the policy loan from the insurance company at only 5% interest. First off, he's now saving that interest that would be going to a leasing company. So if on the back end of the lease, let's say the lease rate is 10%, there is still 5% interest that he's saving. Now, it may not seem like a lot of money, but if you consider the difference between 5% and 10%, it seems like just a 5% spread. But effectively, it's a 100% rate of return. That's every year that he has the loan. So that's one benefit. Obviously, if the interest rate is higher, like 12 or 15%, the rate of return will be even more. Now here's the great thing. Let's say he chooses to pay himself back at 10%. He's being charged 5%, but he's going to pay the loan back at 10%, which means he's now earning that additional 5% interest. And if he's earning the interest instead of the leasing company earning the interest, that's more money going into his cash value. So what we show here is the loan being paid back at 10% interest. And what you see on the left-hand side, this is an example of the cash value growing. Remember, in 25 years, there was $300,000 we showed as if there were no loan. But now he takes the loan. He's going to pay the loan back over 5 years at 10%. And over those 5 years, he's earning that extra interest, which means more cash value going straight into the policy. At the same 25-year mark, there's $303,000. Effectively, he has become his own bank. He's lowered the amount of interest that he would have had to pay to the leasing company, and in essence, that money is going back into his own policy, and he's earning more money. Over the course of that time, in 25 years, that $303,000, taking that one loan and paying it back, getting an additional 5%, now his earnings on this cash value is 5.42%. So that's one loan, one example. Imagine doing this throughout your life. Taking loans, using your policy as your bank, your own source of funds, and being able to fund multiple loans over decades of time. Think about not only the interest you would save with the leasing equipment or whatever it might be, but the amount of money you could put back into your own policy. Loans are not required to be paid back. Let me say that again. Policy loans are not required to be paid back. However, here's the general rule. While you are working and producing income, pay your loans back. Be an honest banker. But in retirement, when you're ready to start taking this tax-free income, don't pay the loans back. Because again, any outstanding loan plus the interest is reduced from your death benefit. Now, there are many uses with a policy loan. You could use the cash value to purchase equipment, just like I showed you. You could use the cash value to buy real estate. You could use the cash value as a down payment to buy a business, buy a building for your business or your practice, to go on vacation, to buy a car. You could use the cash value to do your own hard money lending. Let's say you want to lend money to people and charge them higher interest like a hard money lender. A lot of those hard money loans are 3 to 5 points up front and 12 to 18% interest on the back end. Well, if you can borrow money at 5% and you can make 12 to 18% interest, fantastic. And the list goes on. There are many uses for this cash value. I've simply shared with you one example. Pay yourself interest instead of paying interest to financial institutions and leasing companies, and you will have more wealth. See, whatever you've heard about cash value insurance in the past, I hope this webinar is dispelling some of those myths. It is not what the majority of people think. It truly is a tool of the wealthy, and it's been used for decades by the wealthy. You're seeing here some of the benefits. Understand truly what this can do for you. Being here on the webinar, you've learned a lot of things that may not have been what you thought. We've looked at the 31-year-old and the 40-year-old. Their examples look great. But what about the person in their 50s that's making really good money but hasn't planned well for retirement? What can be done? The answer to that question brings us to the third case study. Let's look at how this 51-year-old business owner is able to turn $700,000 into more than $1.4 million tax-free. This is income that he will begin to take at the age of 70. For many people at this age, Social Security can be maximized at age 68, meaning a person can get the most money from Social Security if they wait until age 68. So we're not pushing this out too far. I'm using age 70 to start the income from the cash value policy. There's a major problem that baby boomers are going to have. It's been talked about in the media. It's been talked about in the medical community, and even scientifically and technologically. And that problem is longevity. The baby boomers will simply live longer than what was expected decades ago. And that longevity problem brings up the problem of income, right? Not running out of money in retirement. No one wants to outlive their money. So we want to look at these options to be able to determine how much income a person can have in retirement. And we're looking at all the different sources of income. This particular 51-year-old owns a business. He'll be able to sell his business and either get a stream of income and get payments from that, or a lump sum that he could turn into a stream of income, like a guaranteed lifetime pension. He'll also have Social Security and this policy cash value, plus some other investments as well. However, none of the other investments he has are tax-free. This cash value policy is tax-free income. He doesn't have to worry about what tax rates will be when he's 70 on this particular pile of money. So if he's taking income from other investments and it's throwing him into a higher tax bracket, he could actually take less income from those other investments and more income from the cash value policy, and that could potentially keep him in a lower tax bracket. We use these cash value policies as a buffer. It's a great tool to be able to keep someone in a lower tax bracket. What we're looking at here is pretty aggressive. So on this 51-year-old, in his first year, he put in $100,000. Total annual outlay, roughly $100,000. Then year 2 through 7, he lowered it to $80,000. Then starting the 8th year, it drops to $20,000. And he only funds the policy through the age of 64. Now, whether you choose to set aside more than this, the same amount or less, that's really up to you. What's nice about these cash value policies is that the math is easy to figure out. So if you put $200K a year into this policy, the total net cash value column would simply double. And if you cut this in half and do $50K in year 1 and $40K in year 2, well, then the cash value numbers would be cut in half. So you can do the math pretty quickly. Again, I want you to notice that at the end of the 7th year, the premium's dropping to $20,000. If he wanted to, he could continue to put in the $80,000. It has that flexibility. But if he wanted to stop in year 8, he also has that flexibility. What we're showing, though, is he's going to fund the policy through the age of 64. And right here at the age of 65, you see all the zeros. That's what I've highlighted here. He will not be putting any more money into the policy. He's done funding. And at the age of 65, there's $940,000 of cash value. His original death benefit was $1.7 million, but it has now grown to $2.5 million. In this example, what he's going to do is stop funding for 5 years, then take income at the age of 70. If you look at this example, you see the funding stop for 5 years, and at the age of 70, he's now going to supplement his other income. As I mentioned, the Social Security, the sale of his business, and his other investments, with this additional $60,000 tax-free. Again, $60,000 tax-free in a 35% tax bracket is going to spend like $90,000. You really need to understand that. $90,000 minus 35% for tax would reduce to $60,000. So in this case, $60,000 through the age of 93, which, by the way, he could take it longer. I just wanted to keep this on one page. That's 24 years of income. And if we look at the calculator, 24 years times 60,000 gives us 1.44 million tax-free. And if he passed away at the age of 93, he would still leave his heirs a $396,000 tax-free death benefit. So really fantastic for someone that got started late, is making great cash flow now, able to save. He only funded this policy for 13 years through the age of 64. It enables him to more than double the amount of money he put in. and not have to worry about what the tax bracket will be in the future because of this tax-free income. A word of caution. If you like what you see here, there's a tendency to want to go out and set this up yourself or use your existing life insurance agent. These cash value policies must be set up correctly from the beginning, or there could be some serious problems. They must be set up with a mutual life insurance company. They must be set up with the correct structure. They must be set up using the right amounts. And they must be set up to allow you flexibility. Must be set up with the correct riders too. In addition to all that, you want to make sure that you work with an advisor that is using the policy themselves as described. You want to be sure that your questions get answered correctly. You want to be able to talk with an advisor about when to stop funding, when to take a loan, when to start taking income in retirement. All that has to be done correctly. All right, we've been through 3 case studies. Quick, stand up, shake your legs, move your arms, twist your head and neck, and stretch. Perfect. Are you ready for some bonus education? I'm going to share a secret with you, which is how to avoid the 4 biggest investing mistakes most business owners make. You know, it was Andrew Carnegie that said the way to become rich is to put all your eggs in one basket and then watch that basket. And that was the point of me sharing the Mark Ford quote with you and showing you your number 1 asset, your number 1 investment, and your number 1 strategy. It's not about diversification. Diversification is a myth that you spread yourself so thin that you can't really focus on anything. Andrew Carnegie gets it right. We want to put our eggs in one basket and watch that basket. Our number 1 asset, our number 1 investment, our number 1 strategy. Let me tell you a quick story. Remember my experience in the stock market, all the uncertainty and confusion? I was talking with a client who went through some of the same things I did in 2008. He told me that he had lost 60% of his portfolio in the crash. He had $1 million in mutual funds that eroded to $400,000. It was one of the worst losses I had ever heard about. But what I couldn't believe is that he was still putting money into the stock market and buying mutual funds. He was still making bad decisions. And I asked him why. He told me he didn't know what else to do. Talk about desperation. Wow. He was simply following the crowd and doing what most people do when it comes to investing, which leads me to the 4 biggest mistakes that most business owners make. Mistake number 1, investing in a 401k, IRA, or qualified plan. You know, most of these, if not all these types of plans, are tied to the stock market. That means that investors in these plans are dealing with volatility, the ups and downs of the market. They're also paying high and hidden fees in most cases and don't even know it, because again, a lot of those fees just don't legally have to be disclosed. These are tax-deferred accounts too, which means taxes aren't paid on this money until some future date. Now, some professionals say that that's a good thing, but I don't think so. Let me give you an example of what I mean. Let's say you walk into a bank and apply for a loan. After looking over your loan application, the banker says, "We'll give you all the money you want." And this sounds pretty amazing, right? But then he says, "But we're not going to tell you what the loan terms are. We'll give you that information later." So you don't know when the loan is due, you don't know what the interest rate is, and you have no idea when you'll have to make your first payment or how much it will be. Would you take the loan? No way, because you're uncertain of the future. And the major problem is that this is how tax-deferred money works. Can you tell me what your tax rates will be 20 or 30 years from now? No, you have no idea what the future tax rates will be and how those rates will affect you. And did you know that in a recent survey, 89% of people believe that their tax rates can only go up over the long term due to this country's unsustainable debt and aging demographics? That means you'll potentially be in a higher tax bracket and on a bigger number in the future. Now on to mistake number 2. The second biggest investing mistake most business owners make is that they relinquish control of their money. They've been told by the so-called experts that they need to give their money to them, the financial advisor, and they'll do a better job with it. The problem is no one can predict the future. Even the best financial advisor out there has no idea what the future holds, and they've lost money too. If you have money in a system that's volatile, you nor the advisor has any idea as to what that money will actually do. Now on to mistake number 3. The third biggest investing mistake most business owners make, and I've seen this over and over again, is they don't know enough about the investments they're putting money into. That's a problem. Remember back in 2006 and 2007 when things were at their peak? There were business owners making investments outside of their business. They were putting money into things that they knew nothing about. These are uneducated financial decisions. Some business owners might make a ton of money in real estate and others will lose a ton of money. Well, what's the difference? It usually boils down to education. The more you know about real estate, the higher the chances you have of succeeding in real estate. Risk essentially is based on knowledge. The more knowledge you have, the less risk you have. Here's an example. I have clients that are doctors and surgeons that own their own business. If I stepped into their job tomorrow, I would completely destroy their practice. Why? Because I know nothing about performing surgery on someone. I don't have the proper education. You must be educated and understand investments before you put money into them. Do you know people that invest in things that they have no idea about? Maybe you've even done that. So we have to be careful. Number 1, remember to focus on your own business. It's your highest rate of return. If you invest outside of your business, you want that money to be guaranteed, liquid, protected, and tax-free. The fourth biggest mistake that most business owners make is that they are always looking for the hot stock or investment opportunity. And we call this distraction. Remember, it was Andrew Carnegie that said he puts all his eggs in one basket and then he watches that basket. It's distraction that causes a lack of focus. When you take your focus off of your business, you lose money. If you're like most successful business owners, again, your highest rate of return is in your own business. I want to beat this into your head. You make the most money in your own business. Why then look for the hot stock pick or latest investment opportunity if your business is already your highest return? Sounds logical, right? But for many business owners, they get distracted by the bright, shiny objects. When you start putting money into other investments or outside of your number one asset, your number one investment, and your number one strategy, you are devaluing your own business. You know what I mean? Remember hearing about a great investment opportunity and getting excited about it, and then all of a sudden, you're distracted from focusing on your business. Even if this is only temporary, it's distraction, and you're losing money. So don't get distracted. Now, we've covered the 4 biggest investing mistakes that most business owners make. The way to avoid these 4 biggest mistakes is simply to stay away from investing in qualified plans like 401ks and IRAs. Put your money in places where it's guaranteed, liquid, protected, and tax-free. Maintain control and educate yourself about what you're doing. Stay focused. Focus on what you know. True wealth is not made in the market. You look at the truly successful people today, they have focused. They've focused on their business. They've focused on 1 or 2 investments. It's about focus and control. So now I've shown you how to avoid the 4 biggest investing mistakes that most business owners make. Isn't that empowering to know? Think of your future and the time and money you will save by implementing these strategies. It will mean more money for you now and in retirement. So you've now learned how the top 1% of business owners save and protect their extra cash flow and generate wealth. You've seen the amazing benefits of cash value insurance, and you've invested in yourself by attending the webinar. Today more than ever, it would be smart to have certainty and predictability in your financial life. Are you ready to take action? To find out what's possible for you, the next step is to qualify for this cash value strategy. You need to be approved by one of the insurance companies that I work with. There's no cost to do so, but you should be serious about moving forward because me and my team are going to go to work for you. What does it take to get an approval? You have to sign an application and do a quick health exam. Contact my team and schedule a time for the application and exam. It's simple and easy. If you have questions in the meantime, you can schedule a call with me and we'll go over your numbers and I'll answer your questions. Discover today how this strategy will work for you.